everybody. I'm Stacy.
And I'm her daughter, Mickey.
And welcome to KiddieNomics. Welcome, everybody, to another fun-filled Friday of Kids Financial Literacy with KiddieNomics. We are super excited for everybody to be here on this Friday. So before I get started, let me share my screen before I introduce our special guest that's returning again to KiddieNomics. So let me first share my screen, everybody. I think all the kiddies are saying hi in the chat box. Okay, there we go. There's KiddieNomics. Okay, so welcome to KiddieNomics. I'd like to welcome all of the new kiddies, right? Let's welcome you to KiddieNomics. If this is your first session of KiddieNomics, don't worry. You can always catch up on our KiddieNomics YouTube channel. But if you say you're new, in the chat box, the kids will welcome you. And of course, welcome back to all of our returning kiddies to KiddieNomics that's here each and every week. We absolutely adore you for being here because we're going to learn fun things every single week, right?
Yeah.
Every week we learn something new and fun. So let's see. Okay, so you may have noticed in our background here that I don't have our KiddieNomics sign up. So we had to do, it's for a reason. So we were actually selected, KiddieNomics was selected to be on the Marilyn Dennis Show, which is a national show here in Canada for anybody joining from outside of Canada. And so that was awesome. And we had to do our taping today, this morning, but we had to take down our signage. So we don't have our KiddieNomics sign up today.
Oh, well.
Yeah, oh well, we'll have it back up next week. So you'll definitely know you're in the right spot. Right, so look out for KiddieNomics on the Marilyn Dennis Show. Thank you to everybody that did participate in that segment for the Marilyn Dennis Show. So thank you so much. That episode should be airing next week, Friday, May 14th on the Marilyn Dennis Show. So that's next week, Friday. Okay. All right. So before I get started, let's do what is KiddieNomics about, right? And then I'll do roll call. Like I know you guys are all waiting for roll call, but let me talk about what is KiddieNomics about, okay? So KiddieNomics is here to help kids ages 8 to 13 to develop a healthy relationship towards financial literacy, helping to start kids off on the right path to have a successful financial future. That's what we want for you. That's what I want for you. That's what she wants for me. That's what we want for everybody, right? We want everybody to have a successful financial future. And with that comes great financial literacy skills, right? So a little bit more about KiddieNomics. Please remember that every single KiddieNomics webinar is recorded. So I'm recording right now, okay? And I put every single KiddieNomics webinar up on our YouTube channel. So if you check out KiddieNomics, our YouTube channel, you'll be able to watch back all of our past videos. But this video will be posted by 8 p.m. Eastern Standard Time tonight. So every Friday, I do post our new video, and it'll be up by 8 o'clock tonight, okay? Also, keep in mind that we cannot see or hear any of you kiddies, right? And that's to maintain your privacy. We love to maintain a very healthy, happy, fun community here on KiddieNomics. That's what we always want. So we always want to make sure that everybody is respectful to everybody. And we can only chat to you through the chat box. So your chat box may be up above, down below, to the side,
or on the corner.
To the corner, I guess, right? So wherever your chat box is, that is where you are going to chat to us. So you can ask us a question or answer a question from the host, but that will all be done in the chat box. And just remember that we always want to maintain your privacy. So please, I never want to see.
Say it?
Yeah, go ahead.
So no ages, no email addresses, no phone numbers.
No phone numbers.
No
personal addresses.
Yeah, no
nothing personal about you, right? So we're gonna ask you questions, and we may, like, I'll do roll call in a minute, so just hang on. But I never want to see anything personal really about you in the chat boxes, right? So we never, ever want to share that, to always maintain your privacy, okay? All right, so before we introduce our special guest, let me get into, oh my gosh, the chat box is very busy. There's already a ton of messages. All right. Okay. So let's do roll call. Roll call. Is everybody joining us from today? Which country are you joining us from today? Oh, I'm so excited, says Akira. I'm so excited for Mother's Day. Yay, me too.
Oh yeah, Mother's Day is on Sunday.
So excited for Mother's Day. So let me see. Area 51. Who said area? Tracy. Hi, Tracy. Brielle is from Canada. Melanie's from Canada. Nicole, Canada. Oh, Melanie. Oh, you're also from Mars, which is awesome. Jenna says Canada. Lathan Blake say Canada, somewhere in the world, but hashtag Canada from Logan. Nice. Ryan says Canada. That must be Jasmine. Hi, Jasmine. Jupiter says Melanie. Nice. Oh, Adonis, you say USA, aka Jupiter, which is interesting. Nice. Akira put up the Canada flags. And yeah, that's it, which is awesome.
What about me? You forgot about me.
I didn't forget about you. Where are you from today?
Let me see. Kawasano School.
Kawasano High School. Oh, something
yes,
with anime.
It's from Haikyuu.
Yes.
It's where they all learn. They're upperclassmates and stuff.
Yes, the anime fan over here. So that's awesome. Let me see. Kepler. Oh, Ivy, you're always from Kepler, which is awesome. I'm gonna have to figure out where Kepler is.
Yeah, you still haven't done
you
that
always say Kepler. So I need to know what solar system this planet is from.
It's out of the whole entire world.
Yes, what is Kepler? Maybe one day you're gonna educate us. This planet Kepler. Where is it? All right. So thank you everybody for doing roll call. Right? We love roll call. Roll call is so much fun. All right. So this week I am going to reintroduce our special guest. So first off, I'm going to thank this special lady, Miss Billie-Jane Bolton-Rojo. She is absolutely phenomenal. Unfortunately, last week we did have a cancellation. And I did tell you guys last week that we were going to be talking about how to start an online store. We were going to specifically talk about how to open up a Shopify account, which was going to be awesome for you guys. We're going to have to rebook that webinar. And we will get Mr. Andrew Day back on the KiddieNomics show. But this week we do have Miss Billie-Jane. She was our guest last week, and we love her, love her, love her, love her on KiddieNomics. She is back again this week, and we're going to talk about one of the pillars of understanding financial literacy and creating wealth, which is insurance. Okay. So who is Miss Billie-Jane? I'm going to tell you she is a phenomenal woman, but I'll read out her bio. I'll read out her bio anyways, which will then tell you that she's still a phenomenal woman. Okay, so Miss Billie-Jane Bolton-Rojo is a financial specialist helping individuals, families, and business owners build a financial legacy. Her pillars involve creating a knowledge legacy with the gift of education and RESPs, protecting legacy with personal insurance, and enhancing business legacy with strategic insurance solutions. She is a mom of 3 awesome kids, helping to teach them financial literacy skills. So we would like to welcome back and give a big KiddieNomics round of applause. Right? Miss Billie-Jane, yay! There she is.
So guys, listen, I know that you guys were so looking forward to the Shopify chat. So was I, my little guy, but I'm so excited to be back. So I hope you're not too disappointed. We're going to still have some fun today, and I can't wait. We're going to be talking about, as Miss Stacy mentioned, we're talking about insurance, but you know what? I'm really focusing it on insurance for kids. Okay, this is going to be really cool, really insightful information for you, for your parents. So I cannot wait to get into it. So let me just share my screen. Sure, you got everything. Let's cancel that. Okay, so share screen, share. All right, and let's get this show on the road. Would like to have the curtain open. All right, we're talking Do you know who taught me all of this? And I said that I wanted my little guy to join the chat today. He loves doing art, so he loves to help me with graphics and stuff like that. He helped me out with this. So I cannot wait for the Shopify chat so he can learn about how he can use, some different tools to share information or share his art. So you get to see some of his art through this. So what are we doing? We're going to be talking today about insurance. I'm going to make sure when we are done, you're going to be an expert on what is insurance. You're going to actually know some history of insurance. You're going to know how you kids can tap into money in the future and how insurance can be like savings and making sure that kids can protect their income after post-secondary. So these are all some concepts that I'm sure you guys have not even heard of before. So first, we're going to talk about what is insurance. Really simply, insurance is a way to protect your money if something goes wrong. Like you see in this picture, if we have a car accident, we can protect our car with car insurance. If something happened to our iPad, we can get insurance for our devices. If we have a boo-boo, we can get insurance for ourselves. It's really just a way to protect something against the unexpected. So why would we get insurance? Okay, because, well, you know what? Normally we like blue skies. We expect every day. We hope every day is a beautiful day, right? But do you think that it might rain sometime in the future? Think that might happen? I think we do get rain, right? We can count on getting some rain, okay? So those are the things when we think of rain, it's like the things that aren't what we're excited about. We like the blue skies. Now, what is the chance that it will rain? Who knows? Maybe it'll rain tomorrow. Maybe it won't. We call this uncertainty. When we don't know, we call that uncertainty. Probability is another way of saying, what is the chance? When you throw the die, what's the chance that you're going to land on 6? Right? What's the chance you'll land on 5? That's uncertainty. That's probability. Okay. So now let's get back to nature. If nature rolls the dice, what do you think? Will it land on rain? And if it lands on rain, are you ready? Because being ready means you don't want to be out there unprepared, right? Get all wet in the rain. So what do? We make sure we're ready. We've got an umbrella, we got a raincoat, so we're smiling, okay? So what we need to do is get an umbrella, and insurance is like your umbrella, okay? It's important because, when we have it just in case it rains. It may not rain, okay? So you may not need your umbrella, but if it does, you're ready. Okay, so that really is what insurance is all about. Now, insurance is better than umbrella, though, I gotta tell you, okay, because insurance is actually money. So let's trade our umbrella for money. We like the bags of money, okay? But wait, let's go back and let's think about this. Okay, so we need an umbrella for rain, right? An umbrella costs money, doesn't it? Okay, so if you want to buy some money, okay, it's insurance. Do you think it costs money? Yeah, we got to pay for it, right? We got to pay for it. What we pay is called premium, okay? So if I got 30 bucks, how many umbrellas can I buy? Okay, pretty much one. You get a nice umbrella, you only get one. Okay. So the thing is, though, when we're looking at insurance, we think, how much insurance can I buy with my $30? Okay. We don't know. However amount, depending on the kind of insurance, whatever amount of insurance or that bag of money you're buying, the amount you pay is called premium. That's like the price. Okay. So now we get insurance. We get the idea behind insurance now, right? So let's start talking a little bit of history. I want to give you guys a bit of a history lesson. Did you know back in ancient Egypt, they had insurance? Okay, they didn't call it that. What it was a whole bunch of people. When we said we want to be prepared for the rain, we can almost think of insurance almost like rainy day money. So back in ancient Egypt, a whole bunch of people in a community would come together, put all of their money together, like imagine a rainy day fund if we need it. And whoever needs it gets that pot of cash, okay? That's what they started back in ancient Egypt. But then time evolved and now people were thinking, all of these merchants, they have merchandise, okay? So they would sell things, and they started to think, oh, we need to have some protection that if we are transporting our stuff and we lose our merchandise, we're going to lose all sorts of money. So they came up with the idea of having this rainy day money, this insurance money. So if they lost their merchandise, they can get access to this money to replace it, okay? That's back in the day. This building, okay, this building is the very first life insurance company in the world, okay? It was the Amicable Society for Perpetual Assurance Office. That's what it was, for the very first life insurance in the world. And this is the first time they started to do insurance for people, okay? So they started to get really sophisticated to find out how much you're going to have to pay for your bag of cash, all right? Now, there are different types of life insurance. We're going to talk today about life insurance. I'm going to talk about some really cool things for kids. But first, before we do that, we need to understand some things. So there's something called term insurance. Term insurance is like renting your bag of money, like getting an apartment. It's up for rent. You only rent it while you need it, okay? That is term insurance, okay? There are a lot more details, but I want to keep this pretty simple for you. So we've got term insurance for a period of time, just while we need it, versus permanent insurance where we have it for life. It's like you buying your house, okay? So you get to buy your bag of money and it's yours forever, okay? That's permanent insurance. And we're going to talk about permanent insurance specifically, okay? So let's say you want to buy a bag of money, okay? We want our bag of money, and we want our bag of money to keep on growing, okay? So what we would do is we'd buy our bag of money, and it's like we'd buy another little bag to get it keep on growing. Yes, question.
Question, can I ask the kids a question? Did everybody
Yes.
understand what term insurance is?
Yeah.
Mickey says yes. Let me see in the chat. Jenna says yes. Who else? I want to make sure everybody understood. Akira says no. Tracy says yes. And Ronald says no. Madeline, no. Coy, yes. I think we're 50-50.
Okay, so let's go back and spend some more time on this. So term insurance, I like to say it's renting your money, okay? You only have it for a period of time. So you know that bag of cash that you want? You only get it for a period of time. You can decide how long you're going to need that for, okay? But it's just for a term. A term could be for 10 years, 20 years. The most you can ever have it is for up till the age of 80 or 85. A term is only for a period of time. When you get to the end of the time, it's done. You got to get back that bag of cash, okay? Just like when we rent an apartment, we pay our rent while we're living there. Afterwards, it's done. It's not ours, okay? As opposed to buying your house where it's yours forever, we call this permanent insurance, where you get to buy this bag of cash and it's yours forever. You never have to give it back. You decide what you want to do with it for life. So that's why I like to say for sale. We like those, okay? So that's the difference between the two. And it can be, there's quite a bit of a difference from renting versus buying, okay? So that's something to think about when we look at the two different types of insurance. But for kids, we're going to talk about permanent insurance because we want to have it for life, and there's some benefits I'm going to tell you about, okay? So with permanent insurance, you're going to buy, yeah.
Sorry, Logan wants to know, is term insurance like a credit card?
No, we don't consider that a credit card where you borrow something, right? You're borrowing for a period of time and you pay it back with interest, okay? Not quite the same thing. Insurance is having access to money when you need it, okay? You're not paying interest on it or anything like that, but you do have to pay for the right to have access to it, okay? So that's what term insurance is. So no, it is not credit. But very good question. It tells me you've been on many KiddieNomics sessions and talking about the different concepts, because I know that Miss Stacy talked a lot about debt and credit stuff, and that's great that you guys are so blessed to be able to tap into that. But no, we're adding a whole new concept today, okay? So you can, with permanent insurance, it's really cool about permanent insurance is not only can you buy your bag of cash, but you can also sort of like have a bit of an additional bag with it that keeps growing, okay? We call the part that keeps growing the investment component, and it's got a special name for insurance people. It's called cash value, okay? Now, you can decide how this money can grow. You can decide what you want to invest in. I know you guys on KiddieNomics who've been here for the long ride, you guys learned about investing. You learned about different types of investments and all that stuff. Guess what? With your insurance, if you want, you can say this little bit of investment that's going to grow with time. You decide what you want to invest in for that. We call that universal life, as opposed to letting the insurance company figure it out. Now, they may choose things just like all the stuff you learned about. They may choose some stocks, or let's say they choose some bonds, or they may choose some real estate assets. All those things that you guys learned about, the insurance company will buy those things too, but they make the decisions. They don't ask you what you think, okay? So when you have that kind of insurance, we call that whole life, because you've got it for your whole life and the insurance company takes care of everything for you, okay? Now, when you get permanent insurance, remember we talked about a house, right? I know that you guys learned about real estate, you know, and so when you guys learned about real estate and you buy a house, you can decide how to pay off your house. You can decide to pay it off over 25 years, let's say, and be done, and the house is yours. Same thing with insurance. You can decide to pay it over your whole life, or what most people like to do is to pay it all off in 20 years and they're done with it and they just enjoy their bag of cash. That's some of the choices you can make with permanent insurance. And in particular, we're talking about whole life. All right, now let's talk about tapping into money in the future, which is the exciting thing we can do with insurance for kids. So we're talking specifically whole life insurance for kids. Yes, Miss Stacy.
We have two questions.
Sure.
I'm gonna try, excuse me, and understand them. So Cheryl wants to know, how does paying back help the person who gave you the money help the person?
Wait, say it again. I think
How does paying back help the person who gave you the money to help the person? Cheryl, can you rewrite your question for me, please? And then I'll say it again in a sec. Okay, thank you. And then, no, she said that she'll rewrite it. And then Tracy wants to know, if you have money, then you spend it all, then you can't get a house, so then what? Oh, I think because you were talking.
I'm just comparing to houses.
Yes.
It's the same idea. We're not buying a house.
Yes.
Okay, we are buying money. All right, we are literally buying a bag of cash. Okay, you decide how big that bag is going to be. But I like to use the example of houses just to help you to understand the concept. Because when you've got a house, when your parents bought your house, they had to decide how they were going to pay it off. Whether they were going to pay it all off in 25 years or whatever we call that term it is that they want to pay off their house, okay? With the same thing with insurance, you can decide how fast you want to pay for your bag of cash, okay? So what a lot of people do is they choose to pay it off in 20 years, but there are companies that let you pay it off even sooner. Some people say, you know what, I'll take my whole life to pay it off. Okay, so the thing with getting insurance for kids is that insurance, since remember we said insurance is for life, it's for our person, it's for us, it's not for our phone, it's not for our computer, it's not for our house, it's for us. And we are like, you know what, the most important, the most valuable thing in this world, okay? But life insurance is for our lives, all right? So the insurance company has to figure out how much they're going to charge to give you this money, Okay, so they have to understand all about you. So they're going to want to know, how old are you? They want to know, are you a girl or are you a boy? They're going to want to know your lifestyle. They want to know all sorts of questions about you to understand who you are so that they can understand how much to charge for your insurance. But guess what? Kids get it cheap because you guys are so young. So this is a great time to get insurance for kids, permanent insurance. And you know what? You've got lots of time. Remember I said there's an investment component? I am sure in the investing sessions, you guys learned all sorts about things like return and interest and dividends and compounding. Yes, Miss Stacy.
So speaking about that, so the kids
Yes.
want to know, two of them, they want to clarify, they really
Yes.
want to understand, how does the insurance make money? If they're giving you the money and then you're paying it back in small amounts, they want to know then, how are they making the money? That was
So
Cheryl's question and Madeline's question.
good question, guys. So insurance, okay? What it is that you are buying a bag of cash. So it's not that you're paying back something, you are buying. It's like, I've got to buy my cup here, I've got to pay something for it. Same idea with insurance. I'm buying some cash that I might need in the future, okay? And life insurance, we know we're definitely going to get it. So we are buying some cash and we got to pay for it, okay? So what we're paying, so when we're buying this bag of cash, the insurance company, they have the cash. So they take that cash and they do something with it. They make it grow. So they invest in different things. That's when we talk about whole life. But if you decide that you want a bag of cash and you want to decide how it's invested, then that's called universal. And then you can say, I want to buy this mutual fund, I want to buy this bond, I want to do this with my bag of cash, okay? But usually, like when it comes to whole life, you don't make those choices. The insurance company does, but you're not paying back this money. What you are doing is buying the right to have this cash. Okay, so that's what insurance is. All right, it's not like a loan that you're paying back. Okay, you are actually buying this money ahead of time. All right, and there's a cost to buying it. All right, so as I said, when you're young, the cost for you to buy this cash is cheap. Okay, it's cheap. And then also this investment, because remember, they're going to invest it, it gets to grow. Did you guys learn about compounding returns? They call it the eighth wonder of the world. You remember hearing about that, Mickey?
Yes. So we
Good.
one in our stocks video. So if anybody goes back to, I think probably our first video with Mr. Scott Roberts.
Awesome.
Stocks. And I think it's also in our bonds video too. So,
awesome. And I know that I think I even mentioned in one of our earlier sessions about saving. I also mentioned compounding return. Compounding return is awesome. It's like called the eighth wonder of the world. It is this snowball. It starts off really small at the top of the hill. And with time, as it goes down, it gets bigger and bigger and bigger. And we need time. Now, you guys are young kiddies in KiddieNomics. You guys got decades of time. So compounding returns is powerful for kids. That's why we want to take advantage of that with insurance, because it can grow so much with time because you guys are so young, okay? Now, you can actually tap into the money from your insurance early. You can use it to go to school. You can use it to buy a house. You can use it to start a business, okay? It is really awesome that with insurance, you can tap into this money ahead of time. This is specifically permanent insurance though, okay? I'm talking specifically about permanent insurance, but you can tap into this money ahead of time. See that kid? He was so happy on his dad's shoulder, okay? So let's talk about this. Let's do some math. You're gonna help me. Yes, Miss Stacy.
Okay, awesome. We're going to do math. Nelma wanted to know the same thing. So Nelma wanted to know, since we're buying money, can we invest the money to get more money, which is what you were explaining.
Exactly. So with with whole life insurance I'm talking about, you don't choose how it's invested. The insurance company has brainiac people who do all of those decision making. So they figure out how to invest it. Okay, that's whole life. But they do have an option for people who want to figure it out themselves because they're really good about investing and they want to do it themselves and they're going to monitor it. You got to monitor it. You got to pay attention to it. Okay. Then you call that universal. But we are talking about whole life, where the insurance company, we use the brain power of their money managers to figure out how to invest. So we're going to do a bit of math, and I want you, I'm sorry, my little thing didn't work out so well. Okay, let's try this. You know what, guys? I did this page. That's why it didn't work. I should have called my son Mateo to do it. Then it would have worked perfectly. But let's say, look at this bag of cash. It's $25,000, Mickey, okay? And it's on sale. You can buy it, okay? So you have to pay $50 a month for 20 years to buy this bag of cash. So let's do some math together. How much would I have to pay in 1 year? It cost me $50 a month to get this bag of cash for 20 years. But let's first talk 1 year. How much would I have to pay? I would have to pay $50 a month times 12 months because there's 12 months in a year. Does that make sense? You following me, Mickey? Yes. So 50 times 12 is $600, okay? But I'm not paying for 1 year. Do you remember how many years I said I have to pay for it?
Wait.
I need to pay for 20 years, okay? So I know how much I have to pay in 1 year. To figure out how much I pay in 20 years, I got to do more math. Remember, in 1 year, I paid 600. We figured that out together. Now I multiply that by 20 years. That becomes $12,000. So I paid $12,000 to get my nice, healthy bag of $25,000. You get it? That is what I'm talking about with this permanent insurance. And it's yours for life, okay? But it grows. And I'm going to show you something. So we're going to look at some numbers. I'm going to consider Mommy buying $25,000 in cash. Mommy is not 10 years old, okay? I'm not going to say how old Mommy is, but Mommy's a bit older than that, all right? So let's say it's me. I'm the Mommy, okay? 47 years of age, and I want to buy $25,000 in cash. How much does this bag of cash cost? Well, for me, when I go to an insurance company and they ask me my age and they ask me if I'm a man or a woman, they may ask me all sorts of questions, and they say, you know what? We're going to charge you $86 a month to buy $25,000 in cash. So that same math we did together, I take $86 a month times 12 months to figure out in 1 year. Then I take that answer and I multiply by 20 years. Guess how much I had to spend? I spent $20,000 for a bag of $25,000 worth of cash. It seems like a lot, but I think it's still a good deal because I put in 20,000 and guess what? I get 25. It's still pretty good, okay? So the thing is, remember, I said that this is growing. So if I want to tap into, I get some investment money. Remember I said I'm going to attach a little investment so it grows. If I tap into that, let's say when I'm 65, I will have an additional $15,000 that I can tap into, okay? That we call the cash value. Let's look at this for kids. This is the power. Let's talk about babies. I'm going to buy a bag of $25,000 in cash for my baby. It's not going to cost me $86 for my baby. It's only going to cost $30. So over 20 years, I paid $7,365 for $25,000. Is that a good deal or what? I think that's pretty good. I need to get that for my baby so my baby doesn't have to pay $20,000 when she's 40, okay? And my baby can tap into $23,000 by the time my baby's 40 years old. By the time my baby's 65 years old, my baby can tap into $88,000. How much could I tap into when I'm 65? Only 15. That sucks, okay? But this is why it's great to get this for kids. Let's look at some older kids. Let's talk about a 5-year-old kid in senior kindergarten. I'm buying the same $25,000 bag of cash. This time, I got to pay $33 a month, a little bit more. but it's still really good because I only have to pay $8,000 for $25,000 in cash. And my 5-year-old, when my 5-year-old is 40, will have access to additional $20,000 to tap into. By the time my 5-year-old is 65 and retired and enjoying life, can tap into $79,000 if they want. Okay? Let's talk about a 10-year-old. Now, a 10-year-old's a bit older. So guess what? It's going to cost a little bit more for this bag of cash. It's going to cost $36 a month. Because my 10-year-old is older than my baby, doesn't have as much time to grow. So my 10-year-old is not going to get $20,000. My 10-year-old is going to get $18,000 by the time they're 40. And by the time they're ready to retire at 65, my 10-year-old will have $71,000 to tap into, not 79. Let's look at a 15-year-old. We could do the same thing, a bit more though, because my 15-year-old is older, but still much better than my price, okay? $40 a month, okay? And my 15-year-old, I'd pay $9,700 for $25,000. By the time my 15-year-old is retired, they can access $61,000, not $79,000 $88,000 like a baby. Okay, so this is the thing that's really, really powerful about permanent insurance for kids. Now, remember I said we're going to pay this off in 20 years. Okay, so for a baby, mom and dad will probably pay it all off before a baby's all grown up and finished school. But let's say we're 15. Do you know what? Mom and dad don't have to pay it all for 20 years. They can say, I'd like it paid off in 20 years. And then when 15-year-old is bigger and on his or her feet, they can say, 15-year-old, here you go, you pay the rest. That's what my dad did to me. I had to pay the rest. But you know what? I was happy because I got really cheap rates that I could pay because now I'm working instead of having to pay big money because I'm older. You understand? So this is really powerful. I also, before we go on from that, I also want to talk about how, oh yes, Miss Stacy.
We have 2 questions while you're on this screen.
Yeah.
Jane. Jenna wants to know if you want the bag of cash, do you get the money first or after you paid for the 20 years?
Right. So the thing is, with this, when I'm talking about accessing money ahead of time, okay, you can still be paying for it and you can access some money. All right. If it's within the 20 years, it's just the money you can access is not as much, but you can tap into some money while you are paying it off. Okay, because you've got this investment that's growing. All right. Now, the thing with insurance, it's quite a bit different. You want to tap into this money. Let's say you want to buy a car or something like that. Or I would rather do something that's of real value. Let's say you want to put a down payment on a house or something. Okay. So that's increasing. So you want to access this money from the insurance company. You can't just say you can access this money from the insurance company. It's not like you just take the cash and run, okay? The insurance company is going to ask you to pay it back because do you know what? The money is actually really for your kids. You just get to tap into it early. Okay, so what you are essentially doing is borrowing the money from the insurance company so you can use it, and then they will keep track. And then later on, when your kids get access to the money, they just deduct if you borrowed anything from it. Okay, so you can go to the insurance company to borrow some of this money, or you can actually take this money, and you know how we show the money? We don't have our bag of cash. We have a paper document. It's called an insurance contract. It's a policy contract. So we have this document that we can take to the bank that represents our bag of cash. And we tell them, look, Mr. Banker, I've got this bag of cash that I can tap into. And so then they'll say, you know what? That's cool. We will lend you money and we'll hang on to this so that if anything should happen, then we can get our money back. Okay. So no matter what, you're borrowing this money to access it because really the money is for your kids or whoever you'd want to give it to later on. Okay. Good question. I'm sorry. You have a question, Miss Stacy.
I have 3 new questions.
Woo! Okay.
Is Tracy wants to know, but why does the money go up? And then I'll ask the other 2 questions
Yes.
from Logan and Jenna.
Okay, so why does the money go up? Because it's invested, right? Just like when you learned about, like, because I know, you know what? Not everyone's seen all the videos. So when you invest, you put your money in some type of instrument. It could be stocks, okay? Which, like Apple, you know, our phones, you can buy a part of the company. And as the company goes up in value, then your ownership goes up in value. That's how you make money. If you have a house, your house is going up in value. Okay. So with insurance, they're buying different things. They could be buying some Apple. They could be buying some houses. They could be buying some other companies. They could be buying things called bonds, which is lending money to somebody to pay us interest. They could be doing all sorts of things with that money that's making it grow. We want our money to work for us. So that's why the money is growing. And because you guys are so young, the money has lots of time to grow. Okay, so good question.
Awesome.
The other two.
We have a question from Logan. Wants to know, are these the actual amount for kids?
This is. I actually went on my computer and I looked up these numbers. Now, this is for one particular company. It's called Equitable Life. There are lots of insurance companies. Remember I showed you in that history slide, there is a company called the Amicable Society for Perpetual Assumption Office. That's what that company was called. But we've got London, well, no, it's called Canada Life. We've got Equitable Life. We've got Manulife. We've got Sun Life. There are so many different insurance companies and they will charge different things because buying an Apple phone is different from buying a Samsung. They all have different prices. So I went to Equitable Life because they do a lot of kids insurance to get an idea how much it would actually cost for a 5-year-old and a 10-year-old and a 15-year-old and a baby, but all girls because the price for boys is a bit different. Okay. Good question, Logan.
Awesome. Jenna wants to know, is it always going to be 20 years or is it just for term insurance?
Oh, this is not even term insurance. Term insurance, you decide how long kind of like you want to rent it for, let's just say, okay? Term insurance could be 10 years, 20 years. Some companies have 30 years. Some companies can say, you tell me, and you say, I want 18 years, okay? That's term insurance. With permanent insurance, you can choose to pay it off over your whole lifetime, or you can choose to pay it off in 20 years. There are some companies that offer other options, like you could pay it off in 10 years, okay? So different companies may have different options available to you, but 20 years is definitely a standard you will find across a lot of companies, okay? Very good question.
We have a lot more questions. So
okay, let's go back.
Tracy wants to know, but can't you just invest in the stock? I think you meant stock market, Tracy. I'm gonna say that's what you meant. So
yes.
I guess we're saying instead of doing insurance, can't you just invest in the stock market? And then I'll ask all the other questions.
Woo! Okay, absolutely. You can just invest in the stock market. The thing with insurance, the thing to think about, remember I was talking first about like having money for the unexpected, like a rainy day account, okay, in a way. Now, if I want to start investing in the stock market tomorrow, my rainy day account is very small. But if something should happen and I need some money, my rainy day account is not big enough to give me what I need. So I can buy some money that if even I need it tomorrow, it'll give me everything that I need tomorrow. And how much did I pay? I paid that small amount of premium to pay for it. For instance, remember this example of me, let's say. If anything should happen, and tomorrow something should happen and I need this 25,000. How much did I pay? I only paid $86 for it. And I got this $25,000. I can invest, absolutely, but it takes time for me to get there, okay? And if the markets go down, I may not have 25,000 at the time that I need it. So this is where insurance is quite different. Insurance is protection against the unexpected. That's the difference here. But what's cool about kids is that this money can be given to your kids and your kids' kids and so on and so forth. And that's what makes insurance really powerful. Even if you don't have all of the money today, by paying your premiums, you get access to it. whenever you need that. Okay.
Okay, so we have a lot of questions. So I'm gonna, guys, I'm gonna ask a few, and then we have to let Miss Billie-Jane continue on, just so that we're not here
This,
for maybe 2
yes,
hours a day.
yes, just because I wanted to show you more stuff, but this is obviously everyone is so keen and interested. I love it. So go ahead. What's the other question?
So Nelma wants to know, like taxes, can insurance prices get higher, like their starting prices? So can insurance prices get higher?
Ah, see, when we talk about permanent insurance in this case, then our premium will not change. The insurance company, at the very beginning, when we entered into an agreement with them that we're buying, like I'm buying my $25,000 bag of cash, at the very beginning, they asked me all sorts of questions to figure out how much they're going to charge. And I said, good, I like it. I sign on the dotted line. Then they cannot change this price. It stays $86 a month until I pay it off. Okay, which in this case, I said I want to pay it off in 20 years. So they cannot just change the price when it comes to permanent insurance. Now, there are different types of insurance where there are no guarantees and they can change the prices. But in this case, we're talking permanent insurance, your price stays the same. Okay, on whatever you had negotiated at the beginning, or more what they told you they were going to charge. Okay.
Awesome.
Good question. Good question.
Okay,
all right.
2 more. Hold on. Let me do
Oh, 2 more.
That's it. 2 more, and then we'll move on. Okay, so Leif and Blake want to know, I thought this is a great question. Why are the prices different from girls and boys?
Ooh, very good question. So remember we were talking, I was mentioning that insurance, what we're talking about is life insurance. That means it's insurance to protect your life. So insurance company ask a lot of questions to understand how there's a term, they call it mortality. Basically, they want to know how well and how long you would live. Okay, because they want to get an idea when you're going to need the cash. All right, because if you never access it ahead of time, that money will be there to give to your kids or whoever you want to give it to. So typically, women outlive men. So that's why, I'm sorry, boys, but that's generally how it works. Women typically outlive men. They know this from all of the research that they've done. So that's why premiums are a little bit lower for girls than boys. Okay, so that's the thing. But insurance companies, they ask a lot of questions. They don't just ask if you're a girl or a boy. They want to know how old you are. Right? They want to know about your health. Are you healthy? This is why it's important, guys. Eat your fruits and vegetables. Be active, be healthy, because they ask all these questions to know how healthy are you, so they can see how much to charge. The healthier you are, the cheaper it is. The younger you are, the cheaper it is. Okay, good question. You think we can go on from this one? Because I got a few more. Last one.
This is from,
oh, sorry, guys.
Logan wants to know, do we go to Equitable Life or do we contact you if they want this?
Yes, you would go to an insurance broker. Okay, so Equitable Life, they don't have their own people as far as I know. They usually sold through brokers. But there are some companies that you can go directly to them, like Canada Life. They've got their own agents. Sun Life, for instance, has their own agent. So if Sun Life is also like Sun Life and Canada Life, they also offer insurance for kids. So if your mom and dad like Canada Life or they like Sun Life, then they can find a Sun Life agent. Okay, but yeah, generally a broker will need to help you with that. Okay, and there are different options out there. I'm just showing an example, but there are different options. So it's important to do your research, and that's nice to have a broker who can help you to see different companies. Okay, so now we talked about life insurance. Now we're going to talk about something called critical illness. Okay, and I'm looking at this for kids. Okay, so I'm looking at a new strategy where you can almost look at it like savings. Okay, that's one way of looking at it. It's not really the best savings approach. Really, whenever you look at insurance, you have to think about the main purpose that it's for. The main purpose is protecting against the unexpected. However, there can be some other bells and whistles attached to it. Okay, so always note, in all of these things I'm talking about, the main purpose is protection, but there's some additional features we can tap into, especially for kids. Did you have a question, Miss Stacy?
Ronell wants to know, can they buy money from different places? I think they mean, I think Ronell wants to know, can they buy insurance from different places?
Absolutely. There are different companies out there that offer insurance. So your parents have lots of options to shop around to see what makes sense for them, because they're, the different companies, they have different rates, they have different sort of provisions, all that kind of stuff. So yes, good question. You can go to different companies for that. So when we talk critical illness, this is a type of insurance that will pay you a bag of cash if you get sick. Okay, so we call this critical illness. All right, and there could be so many different kinds of sicknesses that could happen in life. In fact, you guys probably have met or know somebody in your family that may have gotten really sick. Well, critical illness helps to pay a bag of cash to help them through that time while they're getting better. Okay, now you can get critical illness for kids as well. All right, now if you never get sick, because people are always like, I don't want to pay for this, what if I never get sick? True. If you never get sick, you can get all your money back. We call that return of premium. It's a feature we can add to critical illness so you can get your money back. But let's talk about a critical illness for kids. The premium is cheaper. Remember, I said you guys are young. And we already talked about the difference between boys and girls, right? So those things apply here as well. Premium is cheaper for kids, all right? Your parents or you, when you grow up, because your parents can give it to you when you're all grown up, you can get a bag of cash if you get sick. They're usually up to 25 different kind of conditions that they think of. But for kids, they consider additional things that kids may face, things like type 1 diabetes or muscular dystrophy or cystic fibrosis. Those are things that people really associate with kids. So your parents can get a bag of money if any of those things were to happen. And when you get older, they can give it to you so that when you're older, if anything should happen, you can get a bag of cash. Okay? Now, if you've never gotten sick and you decide you don't want it anymore, then guess what? You can add a feature to cancel it and get all your premiums back. Remember, I said it's called return of premium. So sometimes kids, when they finish school and they're all settled and they're like, I never got sick, and you know what, mom, dad, I don't want this anymore. Fine, they cancel it and they get all their return of premium, which sometimes can be quite a bit of money to help pay for a car or something like that. So sometimes people use it for that purpose. But this type of savings, you are not getting any interest. So it might, you got to consider that if you're just thinking, I'm just doing it for savings, you might be better to put that money in a bank account or put it in some type of investment and have it grow for you. The thing here is that on top of getting this money, if you never need it, is that if you do need it, you'll get a nice little, bag of cash. Okay. So protection first. Yes, Miss Stacy.
So we have a question from Akira. She wants to know, can she choose 100 years to have the money? So as an example, you've used 20 years. She wants to know, can you choose 100 years?
So when we're talking about the permanent, so back to the permanent insurance, yes, like basically when they talk permanent insurance, they're assuming, they say for life, but it's really till age 100. Okay. So you can choose to keep paying your premiums throughout your whole life. If you make it to age 100, you keep paying till age 100. All right. So you can continue to pay for life. But most people, when they're retired, they want to go on vacation and stuff like that. They rather get money than spend money. Okay. So that's why a lot of people like to pay it off early if they can. But absolutely, you can take your life to pay it. And if you do that, then your premium's even cheaper because they spread it out over a longer period of time. Okay. So yes.
Last question. Tracy wants to know, can you get insurance from a bank?
Yes, you can. The different banks also offer insurance, so you can get it through them. Now, I believe you can get it. I think they have people at the bank who will take care of the insurance side of things, who can help you. I believe they do. I know that, for instance, BMO has insurance, RBC has insurance. Okay, but I can't say for sure how you can access it from them if you have to go a certain area of the bank to get it. But the banks do also have their own insurance. They're kind of new to the insurance game because insurance companies have been doing it for centuries, some of them. Yes.
great question from Jenna. What if you get the return of premium, then later on you get sick? What happens?
Well, if you get the return of premium, it's because you canceled it. So no, once you take your money back and you cancel it, the bag of cash is gone. You got all your premiums back. So no. So that's the thing to think about. Do you value this? If you value having that bag of cash just in case, then hang on to it. But if you decide that you want to cancel it and you don't want it, then you can get the money back. Okay. There are some other features about it that's great for me to chat with your parents about, but I really want to keep this fun and light for you guys to see how it could be beneficial to you. Okay. So the return of premium cancellation, I talk about a lot for kids because kids will sometimes cancel it. Okay. Because they don't see the value of it. But the good thing for mom and dad is to know that they get all their money back. Okay. So I want to look at an example of, let's say it cost me $40 to get this bag of cash. This bag of cash is also $25,000, but I'm getting this bag of cash if I get sick. Okay. And it's going to cost me $40. And I decide I want to pay it off in 20 years. Because for kids, there are some companies that also let you pay it off over 20 years. Other companies, they may not offer that option, but there's some companies that do. So I just want to show you how much you would pay in premiums over that time. So in 1 year, you would have paid $480 in premium, but in 20 years, you would have paid, I'm missing a zero, $9,600 in premium. Oh, these numbers are a mess. $9,600 in premium is how much you would have paid. So if you cancel it and you're like, I don't want this anymore and I want my money back, then you could get $9,600 back if you've done that over 20 years, okay? So I want to show you some numbers. Now these numbers are from a different company. The company that I used here is called Desjardins, and they do a lot of critical illness for kids, okay? So I showed what these numbers would look like for babies, a 5-year-old, a 10-year-old, and a 15-year-old. So we won't go through all of them, but you can see here that for a baby, if mom and dad is paying $29 a month, after 20 years and baby's all grown up and says, I don't want this anymore, baby, now grown up, will get $7,000 out of it that they can use to do something else with it. Okay. So, and then you can see these numbers, they're still pretty close if you're 5, 10, or 15. Okay. But I just want to show you that concept that some parents use because they want to have that protection for their kids, but want that extra feature that if their kids don't keep it, they can get some cash. Okay. So now I'm going to talk about something else. One more thing. Let's see how we doing for time. Whoa, Miss Stacy, we had so many questions that we are close to time. What do you want to do?
We can finish it up, but I have a question for you.
Yes.
Because I promised Ronell that I would be asking
No problem.
question. So if you're a girl or a boy and your kids want insurance, will it be different because the numbers of boys and girls are different? Oh, so I guess he's saying, so if you have 2 kids and one is a girl and one is a boy, will their insurance premiums be different?
Correct. They will be. Like, let's say you had twins and they're the exact same age, right? And one's a girl, one's a boy, fraternal twins, then yes, the girls' premiums will be a little bit lower than the boys. Now, I want to let you know, when I was showing you these rates for the girls, the boys is not that much more. We're talking maybe $1 to $2 difference, okay? It is not that significant, but I just wanted to keep it all girls because I was talking about mommy. So I want to be consistent that we're talking all females. But just to let you know, for little kids, the difference is not huge, maybe a couple of bucks, all right, at the most. Okay. So now I want to talk about a different concept. And now this is for our big kids. All right. You're all big and you finished going to school now. All right. I want to talk about some options here. Now, what kind of job do you think maybe you might get when you're done? I got some pictures of some jobs that some people might pursue. I've got a paramedic. I got a doctor, right? I've got an engineer. I've got an artist. Who do you think you will grow up to be? Okay. Like, you can think about what kind of job you might get when you're done school. There is something like called disability insurance, which is something that protects you if you get hurt or if you get sick and you cannot work. And it's really awesome for students. Grown-ups should get it. But for students, the benefit of this is that if you get hurt and you can't work, well, you know, you won't be able to make any money. Okay. Disability insurance keeps paying your salary. So awesome. Okay. If you cannot work because you got sick or injured and you cannot work for an extended period of time. But just like I was talking about babies and things like that, students are still quite young. So their premiums are cheaper because they are still quite a bit younger. Okay. Now, the other thing is that insurance companies, they're going to look at what you are studying and say, what kind of a job are you going to get? So if you're studying engineering, they know you're going to be an engineer. If you're studying medicine, they know you're going to be a doctor. If you're studying law, they know you're going to be a lawyer. If you're doing plumbing, they know you're going to be a plumber. So they look at those things to see how much they're going to charge, and they will consider that even before you start working, usually starting as early as your last year in school. For some, it could be your third year in school. So what's cool is that some insurance companies will give this benefit even before you start working, even if you, let's say, decide not to pursue that job anymore. Okay, they look at what you're studying to figure it out. And honestly, that can be really advantageous because some of the jobs that you might be looking at while you're in school will have some good income opportunity. Okay. And what's cool with this disability insurance is that it can increase as your income grows. There's a feature you can add that it allow it to, that you can get more money depending on how your income grows. But the key thing is that students get a discount. So some companies will give up to 25% off. And that discount will be there if you make any changes to your disability. They'll still apply the discount. So I always encourage parents with students ready to go on to post-secondary, we can help them out and get them this little disability insurance so that at least they've got that. And listen, parents, pass it on to your kids. It's got to be their responsibility, but we're just locking it in for them so they get a good rate. Okay, so this is really cool. If you can't work for a period of time, disability insurance will pay income. And I can tell you a story. There is a young lady who was studying architecture, and in her last year, she went on a ski trip and she fell and she got hurt, and she was hurt for quite a while. She couldn't go and start working. And guess what? Even though she hadn't started working yet, she started to get an income from her disability. Okay, so that's something I want to plant in your minds for kids. Okay, so does this all sound good, but you don't know where to start? I heard so many questions, but what about this company and who do I go to for this? Because we don't know, so many questions, right? Where do we start? So that was so good. I can't remember who asked the questions. Let's get some help. Okay, find an awesome professional who can help you. You can go to an insurance agent who's usually, like, say, a Sun Life agent. They're typically with Sun Life, or you can go to a broker who can look at different companies for you. Okay, and they will turn your frown upside down. Okay, so get some help. All right, so I always love to end with quiz time. Oh, yes, yes.
Hi, Miss Billie-Jane. Sorry, we don't have time for a quiz because we're
okay. Perfect. Well, next time we can do some more. You guys had so many good questions.
Yes, you guys. The kids always ask the most insightful questions, and it's always so many. And then they look up and they're like, "Oh my gosh, it's 6 o'clock."
It is after 6.
This was awesome. It was jam-packed with information. So let's give Miss Billie-Jane a huge round of applause. That was absolutely awesome. Thank you, thank you, thank you so much. Thank you to all the kids that asked all these phenomenal questions today, because I think you guys learned a lot. I think you learned a lot. Let me see. Nelma says, let me see what your question just said. I think that was an awesome response. What did you say, Nelma? New information that's going to be used. Oh, isn't that awesome?
All right.
Right?
Okay.
That's so amazing. So thank you so much. Let me Okay, I will take 2 minutes more of your
Yes.
time. Let's wrap up.
Yeah.
Because it's Friday and it's late, depending on which country you guys are joining us from. So, last question. What would happen if kids became more financially literate? And our answer is
Real change that impacts.
real change that impacts the world. Why? Because you guys, look, today you learned so much about insurance and what you can do with insurance and what you can do when you get older and you're in school. So just the more things that you guys learn about financial literacy, the better that you'll become and just so much success that you guys will have as you guys get older, right? Okay, so we love to call you guys our young financial literacy ambassadors. What is an ambassador? An ambassador is a messenger or representative, and you all make the best representatives out there, the best ambassadors of KiddieNomics. So we like to say here on KiddieNomics, knowledge is our
Superpower.
knowledge is our superpower. So share it, because guess what? The more that you share your knowledge out there to your family, your friends, your community at large, the stronger that you become and the stronger everybody else around you becomes, right? So we thank you for that. All right, let's get into next week. I will put up the schedule for June shortly, but next week we have Miss Alliston Simon. She will be back on KiddieNomics, which is awesome. And we're going to talk about business and corporation. So we talked about sole proprietorship with her a few months ago, sometime in 2020. And next week, now we're going to
And
follow
on my
that.
birthday.
Oh, yes, that's right. We celebrated Mickey's birthday with Miss Alliston. That was, in October, right?
October 30th.
October 30th.
I'm gonna mark that down.
So we'll have her back on. We won't be in costume. We're in costume for that one. That was fun because it was Halloween. But we're going to talk about business and corporation, okay? All right. Following that week, we have a special edition of KiddieNomics. We're going to do a Q&A with Miss Marcy Ian. Many of you know Miss Marcy Ian as the former co-host of The Social, which is a national talk show here in Canada. And now she's an MPP for the Liberal Party in Toronto. And we're super excited to have her on. We would like to prepare some questions ahead of time for Miss Marcy Ian. So if you guys can send me an email or put it in the chat box right now, just some questions that you may have for Miss Marcy Ian. We're going to talk about the power of pivoting and just hearing her journey and her story, because she has a phenomenal story. And so you guys can send me an email at kiddienomics101@gmail.com. But please always remember that you must get your parents' permission.
Okay.
Right? Never do it without your parents' permission. Let's wrap up. All right. So we always want to hear from you. Always want to hear new ideas, new subjects, new topics you want to discuss. I get ideas from you guys. So please, please, please always send them in to me. Send me an email at kiddienomics101@gmail.com with your parents' permission. And of course, if you find the information on here valuable, please like and follow us on
Instagram, Twitter, Facebook, and YouTube, and TikTok.
Instagram, Twitter, Facebook, YouTube, and TikTok. And I did promise that I have a TikTok video up by the end of May. I will stick to that promise.
Mm-hmm.
So we will, I've been marking down which video I want to start with. So I'll get something up on TikTok for us, okay?
2 more weeks and after, like, May stuff.
I know, we're gonna do it. We're gonna do it. Anyways, thank you, Miss Billie-Jane, for another phenomenal session of KiddieNomics. Thank you for coming on this week. We appreciate you beyond words. Thank you to all the kids that joined this week. And we will see you next week, and making sure that there wasn't any additional questions. I'll read them after. Anyways, thank you, everybody. Have a great week, and we'll see you next week. Bye.